Welcome to Total Money Management. We're going to be going over stocks versus property today.
So and a little bit different.
If you've listened to the last couple of the week that was, we've spoken about this masterclass that's been on the cards for a little bit now. And I think before we kind of crack into it, it's important to kind of cover the objectives first. The point of this really is not to say one's better than the other, but really just to kind of peel both investment vehicles back to the 8 principles that we teach and talk about, to give the most objective assessment of both that we can. And I think it's timely. The recent property boom in Australia, has caused a lot of people to be overly bullish about the property market. There's no question a lot of people have done really, really well. And, we're not saying that it's an awful investment either. But we're just giving, trying to put a bit of context and perspective in there as well. I think it's also important to acknowledge that there's a similar sentiment with the stock market, given that over time it always goes up. Mm-hmm. Again, we'll kind of go into that a little bit more throughout this one. So
excellent introduction, Tom. And by the way, we've got a document on it. So if people want to get the paper that we've written, it's about 20 odd pages or something. And as Tom said, what we're trying to do is just say to people, you get this constant, you were stock guys. We're not stock guys. You hate property. No, we don't hate property, right? It's just trying to point out to investors the differences between why stocks and property are not really measurable. Mm-hmm. And it's not really apples for apples, if I can put it to you that way. Because, as you said, Tom, the property market's gone absolutely gangbusters. The stock market's been generally pretty lackluster since 2007. Mm-hmm. Right?
Well, there's usually an asset class that outperforms the others, right?
It's exactly right. And even within stocks, we talk about value versus growth, fundamentals versus technical analysis, right? And what we're trying to say to people is you don't need to be wedded to one asset class in particular, right? It depends on things like valuation. It depends on risk, right? It depends on what your life situation is. So there's a whole raft of things. What we're trying to do is just say, look, when, if you said to me, Steve, I've got $1 million, what do I do? You don't say, well, mate, you should just buy a property, right? Nor do I say, well, you should just put it all in ETFs in the stock market. Right, because you've got to look at the underlying characteristics of both investments, hence the reason why they always talk about diversification, right? Have an investment property, have some super, diversify globally, right? And that's the way, you work it. So we're just trying to sort of get people, what we're trying to do is give you the tools to say, now when it comes to buying a property, I want to think about the rental yield. Is there a market cycle? Because Steve, Tom and Jacob said there is, and I hear all these people going, property only ever goes up, right?
Yeah. Well, I want to just, before we're not talking about property as a home here. We're talking about is an investment. And all investments, whether it be stocks or property, anything, coins, it should be assessed somewhat like cold-bloodedly with data.
Yeah. So numbers over narratives.
This is not about saying, well, don't buy a home for yourself and your family. This is about saying if you've got one, or if you're looking at investing, then this is how you should.
Are you assessing the risk and the yield
unemotionally?
Yep.
Yeah.
And by understanding how and we'll get into this, how they're different.
Yeah.
Right, because stocks, let's boil it at the start. Stocks are different to property, right? There are some characteristics that are the same, but what we want to point out, which we think is different from the usual stocks versus property stuff, is they are different characteristics, and therefore you need to consider that, right? And just quickly, leverage, right? Well, yeah, you can make lots of money. Well, yeah, but you can also lose a lot of money.
Yeah. Well, let's start with risk. So how do you think about risk?
Well, we'll go for Buffett's demonstration, right? Definition. Risk is the permanent loss of capital.
Yep.
right? And in a bull market, you're never going to think about the permanent loss of capital, right? Because you always think that you're going to be, sailing on and doing really well. And that's why, again, if you don't know about market cycles, you're going to get caught because, you're in an upswing. And as we've talked about in the podcast, the week that was and stuff, when you're on a winning streak, it's really hard to seem like you're heading into rough seas, right? And so you've got to, what we're here to do is say, listen, Tom, have you thought about the market cycle? Because, yeah, we know property is really expensive, but have you thought that it will get cheaper? And what we show in the paper and what we'll talk about is the market cycles. You look at it and go, oh, okay, hang on. Well, maybe I don't need to maybe I don't need to rush in.
It's that second level thinking. Have you thought about it going cheaper? Some people mostly would say yes, but they don't actually think about how it impacts them. It's like they go, yeah, we could go cheaper, but it hasn't for the last 20 years, so it probably won't impact me anyway.
Well, it's a recency bias.
Yeah.
So when the narrative is property only goes up, and when you look around, it seems that it's only gone up, and everyone you talk to who's bought a property, it's gone up, then there's very little reason.
Yeah.
Few people are going to sit there and go, but what if the tide changes,
And that's, but you never see the tide change, do you?
No.
Because like you said in a podcast recently, that confirmation bias of, I'm only reading the articles about, like the old Buffett thing, right? Don't ask a barber if you need a haircut, right? And as I say, if you talk to a real estate agent, is it a good time to buy a house? Absolutely. Is it a good time to sell a house? Absolutely. Well, hang on. It can't be good for both of them. And it's like stockbrokers. Should I be in stocks? Oh, yeah.
Absolutely.
Yeah.
Only if it goes up.
Absolutely. Right. And take a long-term perspective, blah, blah, blah.
It's about the framework. We go, look, does every investor have a framework? No. Should you? Yes. And what does that look like?
And don't take your advice from somebody who's got a financial interest in you getting into that asset class.
Yeah. Yeah.
Right. And so that's why if we, on that thing about risk, we talk about this thing called ergodicity, right? And one of the points is single properties are not like, as you mentioned, Tom, before outside, a real estate investment trust, right? A REIT. When you buy a REIT, you're buying a little bit of 35 buildings, right, that are in the ETF. You're not buying just one of the buildings. And there's a really, really big difference because, as you know, with stocks can go gangbusters, but if you've bought a really crappy junior mining company, you ain't going gangbusters. Now, you might be doing even better, but you might be doing a whole lot worse, right? And that's a really, really critical point because, as we've seen in the socials, people make those broad brush statements. Oh, property only ever goes up. Which one? My property or everybody else's? Or the suburb or the country? Because what we know from history is that's not true, right? I think we've got a chart in there somewhere.
Well, you find in that, one of the questions I had just from reading the document over the last few weeks was something that seems to be prevalent is, or an argument is that property is less volatile. So it's less volatile. You can afford to leverage up, and even if there is a property downturn, it's not going to be as dramatic as the stock market.
Well, in Australia, it goes up a lot more than it goes down.
Yeah, because
recently.
Yep.
Again, because
when I say recently,
because we're in
20 years.
That's exactly right, right. And you're right, Jacob. One of the findings is that property is less volatile. But again, what I'm trying to get through to people is property is less volatile. Your property and your $1 million mortgage is dependent upon you being able to service that job for 25 years. Your property value is connected to everybody else's property value because it requires leverage. And that means if you want to sell your property, you've got to have other people out there who are willing to pay that price for it. Right? So there's a whole raft of things that people don't consider because they've just hit that statement of, oh, well, property only ever goes up. And the advantage there of property is that, yes, it does have lower volatility. But the advantage of stocks is if shit hits the fan, I can get rid of my stocks real quick.
Yeah. Or you can rebalance.
Right? And we'll get into that further. But that point is really valid because property has really big transaction costs.
Yeah.
Right? You can't wake up on Monday and go, oh, the market's crazy changed, I'm going to sell my property. Well, you can, but it might take a long time.
Yep.
It might cost you a lot of money. But in a bull market, like you see, there's properties that are selling before they hit the market, right? Well, that's good. But that doesn't mean in 20 years you're still going to be able to go, oh, I'll just flick the switch and, I'll turn that million into my 1.3 to realise the gain.
Yeah. Something we've mentioned before, but I think the main thing with property that everyone likes to talk about is it's all about the capital gain.
Yes.
So they're happy to negatively gear because we're working under the assumption that there'll be a capital gain there that they can use to leverage up, buy the next property, do what have you, create some money on paper. But what happens when that capital gain slows or the capital growth slows or starts to work backwards?
Yep.
That's when it becomes a little bit dangerous, right? And if we're kind of looking at the two, if I look at a property and let's say I bought a property for $500,000, 10 years on, it's now worth $1 million. I can't go, all right, I want to take a bit off the table. I'm going to sell the porch or I'm going to sell a bedroom or I'm going to sell the pool. Like you're all in or you're all out. Yep. Like the big advantage that I see is you can leverage. You might be able to get into a $500,000 property with $50,000. But all of a sudden you're playing with a lot more money. So 10% growth on that, you've doubled your initial investment.
Yeah.
And you don't hear about many people leveraging up to buy stocks. It's just less common.
Yeah, you get. Sorry, Jacob, you go.
They'll use the equity to buy another property. That's generally what happens.
Which is increasing your risk.
Well, exactly.
That's what we're trying to say. The risk is different, right? And even it's the same in stocks where I remember people saying to me they got absolutely towed up in the GFC because they bought stocks on margin and they bought leveraged stocks on margin. So
we've all been there.
But you know what I mean? Like, first of all, you're in for leverage, which is really, really volatile. Then on top of that, you margin loaned it, right? Which makes it even more volatile. And that's why I say in bull markets, everybody's going nuts, right? You guys are laughing, aren't you?
No, we're laughing.
But that's what I mean.
We would still do it.
Yeah. I remember the oil, the leveraged up oil ETF.
Oil barons for a bit.
But you see what I mean? Like it's really, you guys have learnt cheap lessons.
Yeah.
Right? Like, comparatively.
Yeah.
Like you haven't, look, I can tell you, I lost, 250 grand or something in bubble stocks, right? That's an expensive lesson. Now that's 15, nearly 20 years ago, right? That's what I mean. When you look at that, you go, oh, man.
Think of the principle. You didn't think of the risk at the time.
It's exactly right. I was in a bull market. No one could tell me anything. These suckers were going to double in price. I was going to be living with the wife and kids in the Bahamas. We were going to be having fluffy drinks every day. It was fantastic. Why? It's a no-brainer. Meanwhile, the old savvy blokes were like, yeah, mate, yeah.
I'll sell you mine.
I'll sell you my stocks. Away you go, young fella. And that's what happens, right? You forget about risk. You forget about being prudent. Margin loan, hell yeah. How much is the loan? 6%. Man, my stocks are going up 42. I'm going to kill this sucker, right? Into a margin loan.
So let's talk about risk with property then. The underlying characteristics are obviously so much different to stocks.
Yes.
And the risk comes in, like if you think about permanent loss of capital, the risk comes from over-leveraging yourself.
Yes. It's in that sense, it's again, what we're saying with what you'll hear is people making large amounts of money in property. No problem with that. But there are people who lose large amounts of property. I mean, I know people who have done that, who say, and the commonality is always the same. They didn't think about risk, right? Why not? Because property just goes up, right? And it's like, no, not all the time. But and it's like stocks, the longer it goes on, the more wrong we look, right? I think was it you and I, Tom, or you and I, Jacob? We were talking about, broken clocks right twice a day, right? And that's what I'm saying. You go, it's dangerous, and people go, Then when you're correct, no one wants to appreciate it then because you were early, or you're just dirty because you don't like property. Oh, you're just dirty because you're not in the property, mate. No, dude, I'm just telling you, it's really, it's really expensive, and you're taking a lot of risk.
Yeah, well, but again, we're generalising here. There's going to be outliers. Like right now, there's going to be properties you can buy that will, hold their value or still sell because it's a different market. If you've got a luxury property at the Sunshine Coast, for example, and
you're killing it.
You know what I mean? Well, the thing is, right, like, even if the market cools down and not as many, first home buyers entering the market, the people who are looking at those properties probably aren't going to be as affected by the same things as most, the general population. So,
I think it's the thing about property, and the reason why I argue that it's riskier is because, first of all, you've got to use leverage, right? Not all the time, but generally people are going to use leverage, right? Now, you can buy a leveraged ETF, or you can, use margin in stocks, but generally people will use leverage in property.
Yeah.
Right? And then, as you said, Jacob, to make matters either better or worse, you make 500 grand, but instead of saying, oh, well, I'm going to sell a portion of my stock portfolio and, pivot into property, what people are doing is saying, I'm going to the bank and they're going to lend me more money, right? And you're getting all these quote unquote property barons, right? And I'm telling you, the worm turns when interest rates go higher, or as the main point is saying in this, what I'm trying to say to people is it's about lending, right? Property prices are strongly correlated to the banks who will lend money. If the banks, and when the banks stop lending, that's when it rolls over.
Well, that's what we saw in the US with the mortgage-backed securities, right?
Yep.
They were seen to be low risk, and they wanted more and more of these things.
Exactly.
So they had to find people to take out loans.
100%,
so let's
Tom.
just drop our standards.
Right? And after the war, the greater financialisation of property is because it's become an asset and you can use it as collateral. Right? The banks are making a fortune. Commonwealth Bank, 60% loan book is mortgages, right? Their stock price is what? $135 or something.
But while property's climbing, it's a reasonably safe bet for the banks, because if that's the security and they're lending $600,000 to someone who can't service that mortgage effectively, but if they ever have to take that house back over, it's probably going to be worth more. And they can flog it, and it's still a safe bet.
My mate who worked for one of the big four banks, he doesn't anymore, but he said to me, we don't care. He said, we're 80-20. He said, you put in 20%, we put in 80, right? But if, like you said, Tom, if you can't pay it, we've lent $800,000 on $1 million property, you do your 200, and we sell it for 1.1 and we've recovered, right? So again, when you look, and here's a really important point about the risk. From the bank's perspective, and again, it's always about aggregation, right? So when you look at default rates and they say, oh, listen, mate, default rates are really low, 1.5%, 2%. Okay, it's always low at the top, right? And it slides over. But my point with that being, what if you're one of the 2%? You don't give a toss about the other 98% who are not defaulting. You only care about your own. Now, let's look at it from a bank's position. The bank makes 100,000 loans. What's the default rate? 2%. Okay, so they know that probably Tom and Jacob are not going to make it. But it doesn't matter to them because they've got another 99,998 properties that are fine. But you're sitting there going, man, as I think we talked about in the week that was, Michelle Bullock, right? Oh, well, some people are just going to have to stump up, sell their home to stay afloat. Well, you don't want to be one of those people. Who are those people? Those people are generally the ones that bought the latest. Right? It's not old people who have lived in their home for 30 years and they owe, $25,000 on a property worth 1.3 million. We don't have to worry about them. But we're talking to the people who bought last year or the year before. Yeah, when the market's, they've paid expensive prices. It's 13 times income. Interest rates are now at 6.5%. Michelle Bullock's saying they're not going to go down. The government's not spending any money. That's when you look at it and go, man, this is a serious risk. Right? So you've got to take all that. You've got to be cold-blooded and look at the numbers and go, okay, what's the risk? Most people are just simply saying, man, I've got to get into this because I wonder how much I'll make. And for a while, that's been working, right? Exactly the same as stocks.
And you're seeing more and more properties being bought in cash as well. And it kind of makes sense to say, I've got $1 billion, I'll buy a few $1 million properties cash. Because you're not paying, if you're not paying another $800,000, $900,000 in interest.
Yeah, yeah. Well, that's why old people are loving it because we don't have any mortgages, right?
And you
what
can
about
afford for the market to turn a bit then.
Sorry?
You can afford the market to turn a bit then because you own the property.
Yeah. Who cares if your property goes from 1.8 to 1.6? You own it, right? Doesn't matter. But it really does matter if you borrowed 1.6. That's when you start going, okay. And your interest rates have gone from $3,000 a month to $5,000.
Yeah.
I'm going to pay
especially
like
if you paid 1.6 based on a low interest rate. That's risen. Mortgage payments have risen. Fuel, groceries, all the other things have risen.
Absolutely.
The tides, rising, and you're just going,
a cluster, you know what?
And now you're telling me that it's worth less.
Yeah. And Michelle Bullock saying,
you'll get over it.
Just sell it.
Sort it out, mate.
But if you look at, we should talk about long-term returns.
Yeah.
I think we put this chart in a week that was. Did we?
A couple of weeks ago, I think.
Is that right? Yeah. But the 30-year return is that you've got US shares, Australian shares, international shares, Australian property, bonds, and then cash. But what we were saying there again is that's from 1994.
So 7.3% per annum.
Yep.
But that's time frame, right? And I think Tom likes to talk about time frame. Like, what about if it's from 1974?
Yeah.
Or 1984? Like, why is it? Why does it start at 1994?
Well, look at the one below that, which I don't think we put in the week that was, is the investment performance of 10 grand in different asset classes over the last 20 years. But that's 94, but only to 2014. So not the last 10 years. And if you look at it, it's really different, right? And that's why I say most of the people who have done really well out of property in this last cycle are the ones who bought about 2000, right? The turn of the century.
Yeah.
And the reason why was because at that point, property was cheap. There was a flood of money hitting Australia, which we'll explain in the next masterclass. And that's why it's different, right? Because that's why when you say, but hang on, I bought in 2020 and I paid 1.8, and the person says, yeah, I know, because you bought it off me and I bought it for 600, right? That's the thing we're trying to point out to people is you've always got to consider the broader frame that you're in. And I think, as you said, Jacob, with stocks, you can go, oh, man, I buggered that, right? But you can rebalance into the stocks. You can't say, I bought a property for $1 million, it's now worth 800. Oh, well, that's okay. I'll buy a bit more of it to adjust my price.
There's just more options in stocks. You can be a bit more agile. So you can say, okay, what's the sector doing? Is the sector overall pretty cheap at the minute? Okay, I'll rebalance. Oh, no, the sector's actually pretty expensive at the minute. It might be worth taking a loss and moving somewhere else.
Yeah.
I think the difference is if you look at the last 20-year time frame, if you start with $50,000 in property, it's worth a lot now. If you had $50,000 in shares and you didn't leverage up, well, you would have done a lot better in property than shares.
Well, the other thing is too, again, this gets back to leverage, because if I said to you, Tom, I put 500 in shares in 2000 and I've made, argument's sake, 10% a year, right? Well, that's not true. It'll be about 6, right? So let's say I make 6% a year. Now, if I said to you, well, look, instead of that, what I did was I leveraged up in property and I only made 9% per year, but I made 9% on 1.3 million, then you're going, man, you killed it. Mm-hmm. You didn't kill it from the return. You killed it because you used leverage, right? That's the key. So if we look at the next part there about a history of the returns, and this is really important again because when you look at stocks, the returns are not 8% per year. Okay, when you put the geometric return in it, it's actually 6. Then when you put inflation in, it's actually about 2. Right, and again, that's why we're saying to people, if you think, 30 years, 8%, I'm going to have 2.6 million when I'm 65. No, you're not. I can almost guarantee you won't have that much.
Where are all the millionaires in super came out?
Yep, absolutely, because you don't get that return, and it's the same in property. I've got there's this famous case of, I think it's my pronunciation's not very good, Herengruch House Index. It's really famous in Amsterdam, right? And they've got 500 years worth of real estate prices, right? So you bought a house in the canal here in Amsterdam in 1550.
For like a kilo of salt.
Well, a
couple of tulips.
For what back then would have been big money, right?
Yeah.
But if you look at it, what they've said is the real price only has increased about 1% compound per year.
Wow. In the last 500 years.
Yeah. Now, because you think about it, if it went up, let's say, 5% compound per year, right? Well, rule of 72, so that's going to be what? 570, that's...
Every 14 years or so.
10, 14, right? So every 14 years, the price doubles.
It'd be about $3 trillion now.
So it'd be about $3 trillion. Well, it's clearly not $3 trillion. Why not? Because it went... And there's an article there which has got an index which shows you the index is at 100. It goes from 100 to 220, then it goes back to 180, then it goes back to 90, then it goes back to 160. So what we're saying is through that long period of time, you've got to look at, and as you said, Tom, the capital gain is the really important part, right? Because people make big money on the capital gain, not on the rental yield. But the rental yield is actually the more important part of the long-term return.
Because capital gains dissipate.
Well, yeah, plus also, Jacob, you just can't simply compound at 5% or 8% forever. Right? Because you do the numbers, like Perth property, right? Since the COVID, Perth property's gone up 78% in 4 years, right? Well, that's 20% per year. Okay, so that means double in rule of 72, double in about 3.5 years. Okay, so Perth is now, let's say I think it's 750. Actually, I think it's more than that. I think it's about 850. So that means in another 3 years, Perth will be 1.7 million. And that means in another 3 years after that, it'll be 3.5 million. Well, okay.
Probably, and then, 3.5. So in 12 years, it's going to be 7 mil for the average property.
That's what I'm saying.
Let's go invest in Perth.
That's not
what are we doing here?
That's exactly. But that's not going to continue on.
No.
Right?
Yeah, I think also to point out, it sounds like we're hammering property again. The same can be said with stocks because we all like to talk about the averages, but if you're buying a single company, it's like buying a single house. Like you're buying something that could have a completely different path or outcome than the average.
Yeah.
So, if I'm going to go be a stock picker, I've got a really good chance that, I might have some crazy runs. Like if I look back and cherry pick companies and dates, if I went and bought Coca-Cola or Nvidia or Facebook or any of these things when in inception they were quite cheap, they've obviously done stupidly well.
Yep.
Great. But the big advantage that you get in the stock market is the ability to buy a big bag of stocks, right? So you can value it. It's a productive asset in the sense that, if you pick the right ones, you're going to generate an income. There's flexibility because you can sell when you need to. So you can get in and out pretty quickly. You can
Yep.
sell part. You
Liquidity.
can take profits.
Yep.
You can dollar cost average in if it falls to bring down your purchase price. And you can account for the outliers. So if you're buying the ASX 300 companies in there, 10 blow up, but 10 do really, really well. That's when you can look at the average.
Yes.
You know.
It's on the page there, we've got a little section there called path dependence. And what it is it represents the idea of you versus the collective. And I'm always talking about the collective or the aggregate because we don't realise we're all interconnected, right? If my property rises on my street, yours will probably go up, right? But again, it depends when you buy it, right? And so that's what I'm trying to explain with this idea of path dependence. The average is 10%. Some people lost 80%. Some people made 300%. Some people made 200. Some people lost 65. That's what gives you the average. But your path may be the one that lost, 85%. Right? And that's where people get mistaken because they think of the average. And as I said, it's the same with stocks. Stocks go up 8% per year. How much does my portfolio managed by a fund manager go up? Oh, about 2. And it's like, why? Because he's picking individual paths and he's wrong most of the time. As we said, fund managers don't outperform the index 85% of the time. Well, who the hell wants to have someone manage your money who doesn't even beat the average? And now, because of ETFs, you can buy the average. So the equivalent is saying, oh, well, I'll buy a REIT. Right? Now, REITs are mainly commercial property, but the point being, yeah, but I'm not just buying a building, I'm buying a little piece of every building. But even with REITs, you're saying, well, I'm buying a little piece of every building that Tom selected. And it's not every building in Queensland. Tom's picked building in Gladstone, Rockhampton, and 10 in Brisbane. Right? And the returns could be really good or they could be really bad.
Depending on the market cycle.
Well, yeah, and depending on what Tom chose. Tom might be terrible at picking property. He might be really good, but it's risky. And what we do is get this issue of everybody thinking, you just chuck money in the market and you make it. It's like, well, that's not the way it works.
There's a lot of social pressure too to invest in real estate because everyone likes to put their 2 cents in and go, you really need to get in the market.
It's Australian dream, isn't it?
Yeah.
You get it from people you don't even ask for that advice.
Well, people overseas... People overseas say, you mob down there, you're just bloody well obsessed with it. And I think I don't know, I might have said earlier or in one of the podcasts, you get a daily price change on a bloody property. I mean, for God's sake, it's stupid enough on stocks, let alone property.
Yeah. Well, talking of stocks, the same is true if you look at the stock market over the last few hundred years as well. When you account for inflation, the long-term capital gain dissipates.
Yeah.
And that's why we always talk about the yield and that when you buy and most people's investing career is 20 to 30 years. It's not 100 years.
Yes.
So if you pick a 20 to 30 year time frame that is really expensive like now in stocks and you're expecting the next 10 to 15 years to deliver great results, then it's probably going to be disappointed. It's unlikely. But if you selected the previous 20 years where it was cheap, the market was cheap, then you've done really well, and you're living in that time. You're living in that mindset where you just think it will continue.
Yeah.
So it's not just property; it's everything. It's what the price that you pay is.
Yes. What's the price you pay? What's the interest rate? What's the yield? What's the risk around interest rates rising or falling? What's the risk around the yield going up or going down? Right? Rent fluctuates, right? Sometimes it's really expensive like it is now, but it'll probably get really cheap, right? Why? Because there'll be more supply come on. Students won't come to Australia anymore, and there'll be more properties become vacant, right? So that's where, again, you've got to look at it individually as well as collectively. So can you say, well, the property market's booming? Okay, cool. That's good. Okay, that's a big plus. Okay, but now you're going to pay 13 times income. Oh, that's not real good. and interest rates are at 6%, and then probably not going back to 1%. Oh, okay, well, that's not very good. But the rental yield is, you get rental, but the gross yield is really low. Okay, well, that's not very good. Hang on, this is starting not to add up a bit.
Mm-hmm.
But it's counterbalanced by, you'll be right, Jacob, you buy it for $1 million, you'll sell it for 1.3 and you'll make heaps of dollars. Oh, yeah, that's true. Okay, in we go. Right? And that's why I'm saying it's been a fantastic investment. Unbelievable. But please don't think it's going to go on for another 10 or 15 or 20 years, because as we extrapolate out, like with Perth, and say, okay, well, what do you think Perth's going to go up, let's say 15% per year, because it's gone up 20. Again, you look at it and say, okay, well, that's a double in 6 years. Okay, well, Jesus, like you just keep going out and going, well, we've got the Amsterdam thing to show you. Well, at some stages it goes from, being fantastic to being really awful, right? We've got property bubbles that we had in Spain. We've got property bubbles we had in Ireland. We had them in America. We had them in England. We had them in Sweden. We had them in Germany, right? And it's the same with stocks, right? So the principle, the underlying principle that is to both of them is saying you've got to look at those valuations and the risk, because the least amount of risk always is at the top of the market when everything looks like it's gangbusters.
Perceived risk, yeah.
Yeah. Well, Jacob, you don't even think about risk, right? Because your brain is just running on, man, I am going to make money in this, right? And that's the problem. When you take that approach, you're really asking for trouble on any investment.
Yeah.
Right?
Yeah. So let's talk about returns and everything. Is that there's obviously no invisible long-run trend that the risk premium and mean reversion appears, or whether it appears strong.
Yep.
And
no, just on that, sorry. There's no risk premium, and that's a probably separate issue. But what they're saying there is mean reversion.
Yes. Yeah.
Right.
And if investors' returns to wealth exceeded the rate of economic growth or GDP, renters would accumulate wealth at a faster rate and thus worsen the wealth inequality.
Yes, that's what we've got going on now, right? You've got a smaller amount of, Australia's home ownership rate has gone from 70, I think, to 65, somewhere around there, right? So what that means is there's a cohort of people owning multiple properties, right? And we've all seen that, I've got 6, I've got 5, just look at the politicians. Yep. Some of them have got 7, some of them have got 6, 5 and 4 properties, right? So what that worsens inequality, because those people are capturing more of the gain in the cycle. Now, my argument is that may well level up at some stage. But for the last 40 years, being in property has made you a lot of money, right? And that's because, as you pointed out, Tom, and in the document there, in 1980, the interest rates were at 17, right? Well, they got as low as 0. And that's why, again, boomers have done nothing and made lots of money, right? Because we bought the property for, what was it, 69, and now it's, 800. And we paid it off 10 years ago because we kept paying $100 a week. And as interest rates fell and said, no, Jacob, you only need to pay 80. You've gone, I'm going to keep paying 100. So you didn't take 25 years to pay it off.
Mm-hmm. Well, right? Property was 3 times income then anyway.
Yeah, which is the long-term average, and now it's normal. So when you look at the returns overall, you see that there are periods where property does really well. Here, Tom, have a look at that version. What you see is property does really well, and this is the important point, before about 1980, property wasn't a financial asset, right? And what I mean by that is it wasn't something that people were buying and selling, right? It was your home, right? And with 1980, that comes the great deregulation, mortgage-backed securities, right? Jacob, just keep flogging those bloody loans, mate. Sell them to me, I bundle them up, and I sell them on to Tom, and he gets 4%. So you're selling the loan, but Tom's taking the risk, right? Well, what's your incentive? Just keep selling the loans, buddy. Yeah. I don't care I don't care if Steve can afford it or not, right? Because I'm not taking the risk. I'm just transferring it to Tom, right? So that's what's created the problem in the United States, right? And if you look at it long term, what you see is property is like stocks, right? The capital gain is the part that evaporates.
Yeah.
Right? So if you've got, if the long-term capital gain in stocks is about 2 and in property it's about 1.5 or even 1, then you have to say, well, I've had a run where I'm up 40% on my capital gain. Okay. Now, it might take 20 years, but that capital gain ain't going to be the same. It may well be different.
Yeah, whether or not inflation chips away at that or whether it corrects, that's not the point.
Yeah. Well,
we're just talking it.
Yeah, it generally corrects.
Yeah.
Right? And the reason is simple. Why? Because there's nobody left to lend to. Right? This is what the US GFC showed and the other ones in Spain and Ireland. Eventually people go, hang on a second. Right? And there's lots of great papers about the leverage cycle. Right? And what happens is you get an event where people go, whoa, hey, hang on, we need to look at this. You've immediately broken the momentum. People say, actually, I think I'll just stay renting for a while. So suddenly nobody's buying and bidding on property, right, in a really big way. Therefore, the prices, you're saying to me, man, I've got to get rid of this thing because I can't afford it anymore. And now the capital gains disappeared.
Yeah. Well, I was looking at something last week. The median rent at the minute in Australia is 601, I think, or 631. The median mortgage repayment per week is about 940. So renters will look at that and go, well, why would I pay $940 a week when I'll pay 630 and just wait a bit?
Yeah.
Eventually, that'll be the new normal way of thinking.
Yeah. And it's right, Jacob, with those last words, right? The new normal way of thinking. Because we know the behavioural aspects are where everybody suddenly decides to, like I think I said, everybody suddenly, why did everybody suddenly decide to buy property in 2000? Right? Because it started getting some momentum. Banks started lending lots of money. Right? People started going, well, Jacob and Tom have bought property. I should buy property. I've got a bit of equity. Me and the missus have got 6-figure jobs. We're doing all right. Let's jump in.
Well, there's a good chart that you posted on the socials, which was when they halved the capital gains in 2004.
Yeah. That was John Howard. Yeah. Howard, long story short, Howard needed to win an election and he was in big trouble against Kim Beazley. So he halved the capital gains tax and there was a couple of the first homeowners grant and property went gangbusters, right? Because heaps of wealthy people went, man, I can invest in property and get half capital gains tax. Right?
And they're incentivizing people to buy.
Well,
so it's
exactly.
No-brainer.
See, the biggest part of property is the deposit, right? Well, Howard said he's half the deposit. Some people, like rich people, said, listen, Jacob, my boy, John Howard's giving you 15. I'm giving you the other 15. Slip in and buy a property, young fella. And they're on the market, right? That's why they keep feeding the incentives the wrong way, right? They keep feeding it. And again, as we said, Albo's done it with giving people more money for rent. Well, that's great if there's 200,000 houses where you can go, you know what? I'm just going to shift out of this house. Right, because now I can go down and borrow that really nice, rent that really nice place for 500, rather than have this place for 570, right? Because Albo's going to contribute. But if there's no places, well, the power's with the landlord. You're not going to spend $5,000 shifting out of there into another place, right? And that again, it's all tied up. If you have a look, we've got a chart here of the real rates of return on equity in housing, right? And what you see is after the war, Second World War, housing has performed better than property, right? Housing has performed better than equity, right? Stocks. But since 1980, equity's done better than housing. But there's a whole raft of reasons for that. But again, that's, it's no good me saying, oh, listen, Tom, if you'd have invested in World War II, you'd have made, 8.29%, right? You're dead, right? Unless you're Warren Buffett, right? But in the full sample, equity does a little bit better. But again, we're pointing out to, we're saying to people, look, I am not, stock mad. I love stocks. I love stocks more than property. But that doesn't mean I'm biased by saying, oh, no, you just never buy property.
You can't be successful well, that's a lie. You can be. It's very hard to be successful in the area if you only bias on one
asset class. Yeah.
Well, it's hard to survive market cycles. A few of them.
And we know everything cycles.
If you're only biased.
Howard Marks
you can do, but again, Tom, you need to know about the market cycles. Right? That's that's why, what was his name? Oh, he died recently in the US. Sam Zell, right? The old property investor, became billionaire with property, buying and selling. Right? So he didn't buy and hold property for 40 years because it makes 8%. Sam was smart enough to go, man, I've just absolutely killed it here. Sell it to some sucker who's going, hey, this is great. And it's like, yep, by all means. I think we put a few weeks ago on the podcast that building that sold for 330 million, right? And then just was resold again for 80.
Yeah, gross.
Someone's got their pants down there.
Unless that was just, fake transaction and they just wanted to hide 200.
It's people who buy it at the wrong time, right? But that...
We've got another table here, which shows the real rates of return on equity and housing, and across the full sample, most of the real return is attributable to the yield,
yes,
which is what we talk about over and over again now. And dividends account for roughly about 60% of the real equity returns, and rents for about 80% of the real housing returns. So this is rents, yeah, which is housing's equivalent to dividends, right?
Yeah, the rental yield is equivalent to the dividend yield, and the capital gain on both of them is, again, the reason why that's there is to say to people, don't expect huge capital gains if you hold the property over the long term. And again, people say, oh, well, yeah, if you were born in 1980, you'd have made a mozza by now. And it's like, yes, I understand that. But in 2034, in 10 years, if the property's gone down 20%, then from 1980 to 2034, you go, oh, actually, it's not that good.
Yeah.
Do you see what I mean?
Yeah, well, that's the cycles that we talk about, right?
Yeah, so but also too, Jacob, the capital gain part disappears, right? And like you said, Tom, with stocks, you can say, well, I'm, like Buffett, I'm going to sell half of Apple.
Yeah.
Not all of Apple. But you can't do that with a property. You can't sell half the property. You've got to sell the whole shindig, right?
Yeah, well, after 1950, capital gains are the more important for both equities and housing. For equities, real capital gains account for the majority of the total return after 1950, and for housing, only roughly a third. So you've got to take the whole pie into account. Yeah. Is the point, I think, of that table.
That's why I think, that's why we always constantly call bullshit on buy and hold.
Yeah.
Can you do well? Absolutely. But it's generally doing well within a market cycle.
Yep.
And most people get more than one cycle over their investing time frame, which means you're going to get an upside and a downside. Right? And that's the important bit, because at some point you've got to go, hang on, I think there's a downside coming.
Yeah. Well, what's the yield? Again.
That's exactly right. I mean, the gross yield at the moment in property is terrible.
Yeah.
Right?
What was it? I think it was 2% or something.
Well, the gross yield in Brisbane at the moment is 3.6. Now that's gross.
Yeah.
Now then, if you say, okay, well then I'm going to take away management fees, taxes, maintenance, all that sort of stuff, you go, man, that's awful.
But that's largely made up of people who bought at significantly lower valuations than today.
No. They're the people who buy at the high price. You see, that's the yield
3.6.
Yeah, because...
After expenses, I'm surprised it's not negative.
No. Before expenses.
Oh.
That's the gross yield. So what I'm saying is
okay.
You're actually getting them probably about 1 to 1.5. Right? And, as I say, you've got $1 million loan over this place you bought in Brisbane suburbs that was, 600,000 5 years ago, and now it's 950.
Does that account for inflation as well? No.
Gross, no.
No. So, yeah.
That's why I'm saying, you're really rolling the dice on that sucker, right? Because you think you're going to make the capital gain. And what Jacob just alluded to or showed is the capital gain is not the big part of the profit in stocks or in property.
Over the long term.
Yes. So can you do it in 10 or 20 years? Absolutely, no argument. But the longer it goes on, the more careful you've got to be because you're not going to capture it.
Yeah, have a bit of self-awareness to go, I'm doing really well right now. Maybe I'll take some money off the table.
Yes, but that's the argument where I'm saying you can't do that with property. That's what makes it a different investment from stocks. In stocks, you can go, man, Jacob was right. I'm going to sell half my Apple portfolio.
Yeah.
You can't go, you know what, Jacob's right. I'm going to sell half of my house. Well, you can't do that, right? And that's, again, why we're saying when you look at stocks and property, you've got to look at it under those characteristics, right? Ergodicity, what's the risks? Because property has a lot more idiosyncratic risk, right? Which is just a fancy word for specific risks related to the property, right? Not related to the property market as a whole.
Yeah.
So let's run through it with the 8 principles.
Oh, yeah, good idea.
Yeah, so systematic. Both stocks and property can benefit from a systematic approach, which is what we always advise with any sort of investment. Although property in most cases is going to require larger amounts of capital. It's also going to entail more risk. So decisions around property need to be assessed under different criteria, given these characteristics, right? Because you can't average down.
Yeah.
Yeah. So just have, I just want to highlight, have a plan. If you don't have one and you're looking to get into any form of investing, think about how you're going to develop a plan before you do that.
And a process.
But that's what I meant.
And a process.
A framework and a process.
Sorry,
Just something so you go, okay, if this, then what?
Yes.
Is the important thing. The second principle being mean reversion. Both stocks and property as asset classes do always revert to the mean.
Yep.
So investors in both classes should take note, not just one or the other. Trees don't always grow to the sky. They eventually fall down, right? And neither do houses. Overpriced stocks or property can take a long time to recover, which is why you get this bull market mentality where I've never seen a bear market really in my adult life.
Yeah.
And then I was a kid before that. So if we hadn't taken the time to really start to understand investing over the last 10 years, it would be like everyone else going, it always goes to the moon.
Yeah, property never goes down.
But we've still never felt it.
And we've still never felt it. So even we find it difficult, Tom, to go, oh, well, maybe the next 15 years aren't going to be as lovely.
100%.
So,
but it's also, and to be quite honest, and say, man, maybe Steve's wrong.
Yeah.
Maybe this time is different.
Yeah.
Right? And I'm saying, well, could be, but man, oh man, if I'm right, you're going to be looking real ugly.
Yeah. I mean, the Melbourne land boom in 1982, and yes, it's a long time ago, but it's very relevant, took until 1952 to recover. It's like if you were sat there holding that for 60 years, you'd be like, Jesus Christ. Like, you wouldn't have. You'd have probably sold it or someone else would have.
It's just a home, probably.
We'll talk more about that when the next masterclass on we're going to zero in on property a little bit more, but it gives you an idea. All I'm trying to say to people is, look, please stop thinking it's just going to go up forever, right? Because you're going to make a done decision with a lot of money.
Yeah.
Might it go up for another 2 years? Absolutely. But we're trying to give you a framework to say, okay, Steve talked about risk, about yield, well, hang on, I can get 5% in cash. What am I doing buying a Brisbane property at, 1?
You've got to at least get 6, 7 or 8 to account for the risk.
Absolutely.
So the third principle being market cycles, which we talk about a lot, and it's very important, and both stocks and properties will go through these cycles, and in a 20 or 30 year period, you'll have bull markets and bear markets, whether they're long or short, and just understanding where you are in that cycle before you make an investment decision is incredibly important.
Yep, and it go and look at history, right? Because you can see that it cycles, and if you want to say, Steve, you're full of it, this time's different, okay, I don't have a problem. But you better be right, because history says it's more than likely probably going to go down. Right?
Yep. Next point, asset allocation. I mean, we go on about this a lot. But if you look at the data, property generally make up a larger proportion of wealth. But this also includes owner-occupiers as well.
Yep.
In investment terms, using leverage will automatically increase your risk level.
Yep.
Buy low, sell high. So if you time it right, property can lead to outrageous returns thanks to leverage.
Absolutely.
You can leverage stocks as well. Most people are rightfully hesitant to do this, and the interest rates charged and margin calls can be seriously awful.
Yeah.
It can just take you out.
Yeah.
And then diversify, right? The problem with property is you can't, or the inability to reduce your risk by spreading your investments, because generally it's a larger buy-in. Most people can't, diversify as easily.
Yep. The key point is rebalancing. If anyone said to me, Steve, what's the argument? My argument would be, regardless of those other 7 principles, the ability to rebalance in stocks is the advantage. Now, I'm not talking about what Jacob said at the start where, me and the missus bought a home and we're going to live here forever. No problem. I haven't got a problem with that. As an investment, the thing that makes money is rebalancing, right? Which is taken from the profits, and then when it falls, you put it back in. You cannot do that with property, but you can do it with stocks. And there's lots of studies out there that show you can have a stock cash portfolio mix that beats buy and hold over the long term. Now, you can argue whether it's 7 or 7.2 or 6.8, but what I'm saying is the stocks cash rebalance is the way to make money. That's what Buffett's doing at the moment. He's selling lots of Apple. He's selling lots of Bank of America. He's cashing up because he knows there's going to be a time at some stage where he's going to deploy it again.
But also he's protecting himself from potential downside.
Absolutely.
If the market drops, a lower percentage of his overall portfolio is exposed.
Yes, exactly.
But he also has a large amount of cash ready to deploy and bring his average cost down. So if he's bought Apple at $1 and, he sold most of it at $2, but his average price is now $1, and serious market crash falls to 80 cents, he can now buy a bunch at 80 cents.
Yep.
And his average cost might be 84 cents.
Yep.
Well, even if it's not a serious market crash and it just tapers off over the next 5 years, he's getting 5%. I think it's 6% even in cash over there. So it's like, okay, unless I'm getting 8 to 10%, what's the point?
Well, yeah, like the whole goal, right? In a falling market, the closer you can stay, or the closer you can get your average price per share to the current spot price, the better off you'll be.
Yeah.
Yep.
And the only way to do that is to have some spare cash.
Well, and
the only way
that's
to do that is with proper asset allocation and rebalancing.
And rebalancing. Right? And that's why I say I'm not biased against property. I just look at the underlying characteristics and say it's really hard to sell a property if you've made $300,000 because you feel like you can't have another bite at it. Right? Then you've got all the transaction costs. Now, the other one too, and I'll make this the last point, managing the property eats up a lot of time, right? Most people are outsourced it to a property manager these days, but that costs you money, right? So that eats away at your return. And as I'm fond of saying, BHP doesn't ring you and go, the taps are broken, right? I need new light bulbs, or, my kid put a fist in the wall or something like that, right? It's so much easier to deal with it with stocks. Anyway, that's the wash up, gentlemen. What's the...
I think from my perspective, feel free to ask if you're listening to this and you've got questions about stocks or property, feel free to reach out. We're currently getting a lot of questions through the socials, and we want to answer them in a way that makes sense to the majority of people, unbiased. So if you're listening to this and you have questions, please reach out. Also, if you're thinking about how can I develop a systematic approach to investing, we've got plenty of information on the website, and we're happy to have a chat, like a no obligation chat to someone over the phone, because we feel like it's important for people to understand this.
Absolutely.
So reach out, and on that, we'll knock it on the nose at an hour. Well done, gents.
Well done, gents.
Thank you.
Thanks for attending the, what is it, mate? The
Masterclass.
masterclass.
Thanks.
Thanks.